Good morning and welcome to another segment of Sarah's Opening Bell. I'm your host, Sarah Bryant. Thanks so much for tuning in. So last Friday, there were a number of news headlines that may have had many of you concerned for your stock market game portfolios. Ones like Wall Street's worst week in a month closes out with even more losses, and stocks tumble amid bond market pummeling. So the Associated Press reported that last Friday, October 20th, the S&P 500 fell 1.3% for a fourth straight drop. The Dow Jones sank 286 points or 0.9%, and the Nasdaq Composite tumbled 1.5%. Now, although the markets are making some recovery this week, the reason cited for the market's fall was the Federal Reserve's chair announcement that the Fed will maintain its current high interest rate of 5.4%. So when the Federal Reserve, which is the central bank of the United States, raises interest rates, it typically lowers the returns in the stock market. So let's dive into a simple explanation for why this happens. First, simply put, higher interest rates means that borrowing money becomes more expensive. Companies often rely on borrowing funds to fund their operations, expand their businesses, or invest in new projects. Now, when borrowing costs go up, companies may find it more challenging to borrow money or may have to pay higher interest rates on their existing debts. This can lead to reduced profits and slower growth for companies, which can negatively impact their stock prices. Why negatively? Well, higher interest rates can make bonds and other fixed income investments more attractive compared to stocks. So when interest rates rise, bond yields tend to increase as well. So this can incentivize investors to want to shift their money from stocks to bonds because they are now seeking safer and more stable returns. So as a result, the demand for stocks may decrease, causing stock prices to decline. And if you're wondering, a bond yield simply refers to the return or the profit an investor earns from owning a bond. It represents the interest that's paid by the bond issuer, such as a government or corporation, in relation to the bond's current market price. So bond yields or returns are influenced by a number of factors, including current interest rates, the creditworthiness of the issuer, the bond's term or maturity date, and market demand for bonds. And right now, as interest rates rise, bond yields tend to increase, and new bonds with higher yields are becoming more attractive to investors. And are you one of them? So irrespective of market fluctuations, bonds are a great option to consider when attempting to diversify your portfolio with less risky and more stable investments. But that's all for now because markets are now open.